He's raised over $70 million. You're about to get his biggest insights on that journey and mistakes so you don't have to make them. Check out the first one.
3 months of spending all of this time with a bunch of different investors at the Series A level that I was raising the wrong round. The second I shifted to talking to seed investors, I had a way better response, and we had a term sheet within a few weeks.
He was getting good feedback from Series A investors, but they weren't writing a check until he switched to seed investors. Next insight.
You need the money to build the company, and you want to find the right investors, and it's impossible to predict where it's going to come from.
It was impossible to predict which investor was actually going to write the check.
Whatever the thesis is on the website doesn't necessarily mean that means no to you if you don't fit in that thesis. It just means that's their 80-20 directional focus of their attention. But good deals, great companies will get invested in.
This one surprised me a bit because I've been telling founders to focus on investors that are thesis aligned to what you're doing. And that's true still, but his point is that he still got checks from ones that were outside of his thesis. At the end of the day, investors are in the business of making significant returns to their LPs, so don't forget that. This next insight you inherently won't want to do, but it will accelerate your funding journey.
You have to run a tight process and you have to push for the no. And if someone is really excited, they will put pen to paper. And if they're not, they won't. And it's totally fine to get that no. You just want the data. The clarity is where you end up winning. Of course, they want to see it because this is going to be a very interesting space, an interesting vertical. And at some point, this could be, the next Uber or something like that. And so why would they want to, push me away?
It's so easy to walk away from a meeting feeling like it went so well. Of course, they'd write a check if we asked. But then if you didn't push for the yes or the no, you don't actually know. In addition to fundraising, we talked about how they hit product market fit and how they got conviction to even start the company.
We ran a test with 11 of our friends where it was very, MVP type test. We picked up their clothes. We cleaned them at James's parents' shop. We delivered them back. Everybody was fired up. The consensus feedback of hey, this is great. When are you coming back?
I love those early day stories, getting to product market fit and getting that conviction. The rest of the episode, you're going to get more details on these points as well as a couple other hidden gems all around fundraising and hitting product market fit from Ajay, the founder of Rinse. My name's Adam O'Donnell and this is the Founder Initiative. Let's go. We're going to jump right to the beginning of the interview where we're talking about investor thesis alignment.
That's where you can spend a lot of time trying to do research on websites and figure out theses. You can go network and meet with VCs even when you're not fundraising. You can spend all of this effort. And the reality is the most important thing for when you show up to actually raise money is you have a great business and you have great fundamentals and great metrics. And if you can spend your time doing that instead of the other stuff in the interim, it's going to be way better off because VCs want to fund great companies. Investors want to fund great companies. Some of the biggest mistakes I made early on, I was raising for the wrong round. So as an example, when I was out and we needed to raise a seed round, I was talking to all the Series A investors and I was getting a lot of really positive feedback from the Series A investors, the ones that I thought would love what we're doing, the tech-enabled service, marketplace, on-demand economy, all this sort of stuff. And despite all the positive feedback, nobody was giving me a term sheet. Nobody was actually putting numbers in front of me. And I realized probably after 3 months of spending all of this time with a bunch of different investors at the Series A level that I was raising the wrong round. The second I shifted to talking to seed investors, I had a way better response and we had a term sheet within a few weeks. And so, I think you can do your research on their thesis, you can do your research on the types of companies they invest in, but if you're raising at the wrong stage, it's not going to go anywhere. And so I think that's where I would look at do the research to understand whether you're talking to the right audience. If you're at a Series B level, don't talk to middle market private equity. If you're at a Series Seed level, don't talk to A or B, because you can waste a lot of time. Because no investor is going to say, if they're Series A and you're Series Seed and they like what you're doing directionally, they're going to give you positive feedback because they want you to come back at the Series A, but they're still not going to put money in front of you or a term sheet in front of you. And so I think that was a big lesson that I learned. But once I learned, hey, narrow in on the right stage of investor, then I also learned it doesn't make sense to then limit that pool to who I think is going to invest. The key is cast a wide net and run a very efficient process in a tight time frame. So those all can be kind of conflicting, but in general, that's why fundraising is really hard and it's a bit all-encompassing. But you have to go hard. You have to do it in a tight time frame. You can't let it distract. But you also should not avoid conversations because it is very hard to predict who has the money and who's excited about what you're building. Had a breakfast. We talked about it. This was San Francisco. He flew back to New York and then 2 weeks later was back in San Francisco. And we ran a test with 11 of our friends where it was very, MVP type test. We picked up their clothes. We cleaned them at James's parents' shop. We delivered them back. Everybody was fired up. They were, there was the consensus feedback of like, hey, this is great. When are you coming back? And, we weren't coming back. We were just like running a test, but they all paid us too. That was, James had this aha moment where we charged them at cost. We didn't make any money, but we had revenue. They literally paid us for the service. And so we knew there was something there. And that was the start of trying to build it. We didn't incorporate it until March 2013. And then we built out to like a launch where we are actually coming back was in May 2013 when we started serving 11 customers. And we said, hey, if we come today and you want us next week, we'll be there next week. And we started building there.
Very cool. So you're saying within like basically January of 2013, we got a timeline here to help us. So you're actually already doing, I hope you got some nuggets. If you want the full transcript, DM me on LinkedIn at Adam O'Donnell. Boom.